Hey guys, welcome to the Cost of Money podcast, which we host once a week to cover a wide variety of topics on actually the rise and fall of currencies and a myriad of other things that's relevant to you as someone that's looking to capitalize on the currency trends as well as currency evolution as we are seeing with the rise of cryptocurrency. And today's topic is going to be the value of fiat money from a historical context, which I think is going to lay the foundation of how and why cryptocurrency was able to come in and gain adoption because of weaknesses in the fiat system. And that is so important to understand because many of us may participate in cryptocurrency without really understanding its nature and its mechanism and um, the pain points that it has come to resolve, and why very intellectual individuals, and I'm talking about uh, billionaires to the likes of Bill Gates and Sir Richard Branson and the myriad of other intellectual individuals, executives of Googles and Facebooks, are buying into this money that you can never touch, and why this has become a global phenomena that is still amongst the intellectuals, and day by day it is getting reaching more and more of the everyday individuals through people like us. But in order for us to reach through to those individuals, we definitely need to understand where the current system is failing. And we're also seeing some of that right now in the midst of what is now a global pandemic and the financial implications of so many of the facilities being locked and disabled, or not in service, or not as convenient um, to operate through. So there's a lot of friction in the fiat system that has laid the foundation for crypto to even become a phenomena. And those pinpoints are what we're going to exploit, is the actual pathway to 2009, 2010, where cryptocurrency actually first began to dawn, and kind of the prerequisites that were in place for crypto to gain adoption. Because truthfully, there could have been a reality in which Satoshi Nakamoto posted that white paper and it didn't gain the attraction that it did. It might have just been in a small community. It could have been just something that faded into the background of the internet and never become the dominant form of digital currency that it is becoming right now. And so why did it gain adoption? There was a lot of pain and suffering and weaknesses in the fiat system that it came to solve, and boy did it come at an amazing time. And I think if it didn't come at that time, if it came during economic euphoria, it might have slipped in the unknowns of the bowels of the internet. But it did come at a time where people were much more receptive to it. And with that, we have our wonderful guest of honor, Sharpan, who is going to be giving us a much more in-depth understanding of, again, the value of money from a historical context, and again, laying the foundation of why cryptocurrency could even become a thing. With that, I hand the mic over to our honorary guest.
Honorary guest. Can you hear me?
Yep.
Okay, great. Um, One second. Okay, great. So, yes, I would like to, welcome everybody to the first uh, podcast on the concept of the money markets, and we call it the cost of money. And really, this podcast happens once a week, and is really going to be interesting because I don't think that there is I don't think we have all the solutions. I think that this podcast actually will evolve into something where we are very much seeking, um, you know, most of the time, because we're going to be undergoing a subject matter that as it overlays the paradigm of cryptocurrencies, is going to involve almost every single crypto asset in circulation. And so that, for that to transpire in a meaningful way, we're talking about a complete paradigm shift that will take time, but will also take cooperation. And so I'm excited to see where this goes, because my goal with this is obviously to lay the foundation in the first several episodes and to kind of get everyone up to speed, so that people that are tuning in later can also watch that, and then present the solution that we have in conjunction, and open this up to people that are working in the specific field, to come on and see how they are attempting to solve this structural issue, and how that can evolve the entire market overall. So it's a really nerdy podcast. It's a real, it's going to get very in detail as it evolves, over the next couple of weeks. And what we are trying to do here is gargantuan. And so that's just the preface of it. Obviously, we are highly motivated, incentivized, because we feel like we have a solution, and we very much hope that it is the solution, but that is going to be tested. And you're going to go, and all of the viewers, both that are going to watch as it happens, but also historic, like that'll watch in the future, are going to see us go through that process, and that's going to be really exciting. So um, the the premise of today, Sal, I think what was the exact title for today?
The value of fiat.
Yeah, time value of money and fiat.
The
So
value of fiat.
yeah, got it. So I mean, maybe people watching this might have, if they have a background in classical economics, then they would be able to even further elucidate some of the topics that I'm going to cover. Obviously, I'm going to try to keep it succinct, for the purpose of uh, this is real, just historical context, and everything that we're going to talk about on today's webinar is going to get demolished with the inception of cryptocurrencies. But it's very, very important, because if you don't understand uh, the 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 underlying structures that made pre-crypto financial systems work, which is, this is the most important one of that, then the crypto financial system might be void of that structure, because that's always the case with new technologies. They're solving a problem, and then they forget, in their ambition to solve a problem, they leave something out that they saw as maybe a defect that actually played a very important role in that previous system working. And so they're always kind of dealing with the systems of the past, and this is for any emergent technology, and combining that with the ambitions to make things probably faster and cheaper and things like that. So that's kind of the deal today. So I'm going to overlay a couple of points, and again, people that are classically trained in economics will be able to really gauge this. But my goal is to simplify this, because it's one of those topics. It's one of the things that I'm also terribly shocked that people don't think about more often, just out of curiosity as to something that affects them really in a prevalent fashion. So yeah, it's one of those. I think this can become a great kind of econ 101 type of thing, or maybe like 505. So with that being said, the historical context, I'm not talking about money, because that's a completely different podcast that we should do actually on the medium of exchange that evolved to become money. And then money is the medium of exchange today. Okay, assuming that there's this thing called money, Vitalik Buterin describes it as a game where you get to accrue points, and the only function of the game is this trick you do where you reduce your points, and someone else, to the proportion that you reduce your points, gains points. And that's what he expresses as, let's say, money. A really interesting way of looking at it, because what that, I think he's trying to be somewhat comical, but I mean, there is a definite, he has consciously or unconsciously, I would imagine consciously because he's brilliant, he has spot on hit most important element of a successful financial system. Now, humans have attempted to create money in so many different ways throughout history. It's unbelievable, actually, and most of them we don't know. Just like all of our kind of relative, our ancestors that were relative to us that did not make it. We obviously think we're the only humans because we made it. And so, this most successful system will prevail. And so we then think that was the only one that ever existed, or that was the only one that could have ever existed, but that's typically not the case. And, you're always a victim of recency bias, definitely with evolution, but also I would imagine with money. So we take for granted, and I'm no fan of, again, I'm just making a lot of assumptions that there's the understanding of kind of modern fiat currency and how that's just printed. But assuming that's there, and assuming that we all buy into the fact that that is money, because that's kind of the basis of something becoming money is consensus. Assuming that's all there, like we're not going to even dig into that. Assuming that's there, and whether you're a fan of it or not, in the way that it lives right now, the one thing that we know, it is the most successful thing that ever existed, a la it made it. And so that, and typically, I always find it too kind of, very arrogant to think that something made it by not being the best, in its sort of evolution. That doesn't make it perfect. It just makes it better than every other nonsensical operation that was ever created. And you can allocate that to someone thinking seashells is a good form of money. Of course, unless you're on a beach, and in which case it's a really horrible form of money. Or maybe you think that very interesting types of plants are types of money, which humans thought for a very long time. Of course, unless you're in the place exactly where that grows. And so, we have come to create this fiat model as an evolution of many different models that is the greatest thing that we've ever created up until this point. Obviously, I would agree that crypto is better. So with that being said, what is the most important addition? I mean, I can't even call it an addition, but what is the most important element of money that isn't the money itself? Because we just agreed that somehow it evolved to what it is, fiat currency, governments print them, and they're backed by the sovereignty of the state, and fine, all of that's well and good. Apart from the fact that we all accept it as tender, what is the most important element of that system, apart from the underlying consensus fiat itself? The most important thing, and this has emerged also over many iterations of failed attempts by different civilizations, is the concept of interest. And interest is one of the most controversial concepts in economics. I mean, it slices across religions, it slices across civilizations, it has God involved, it has your local guy involved. It's the most kind of it's the most polarizing concept about money that's actually not the money itself. So assuming we can all agree on that, interest then becomes, what is this? Again, there's probably a really interesting podcast to be done on the mathematical inception of interest. From a quantitative level, we're not going to go there. We're just going to assume that math created interest. And that's interesting to dive into that. But let's just say that math created interest, and now there's a mathematical construct for the first version of interest, which is in Vitalik's model. There's now a rule number 2, which is not just I lose points and you gain points, which is essentially transaction, purchase of something. There's now the second rule of the game, which is I can decrease points. You will increase points to the degree that I decrease them. But it's under a time constraint in which my points will come back to me more than I had before, and you will lose all those points that I just came back to me that I gave you in the first place, and you will lose more than you had before. And so that's essentially what interest is, rudimentarily speaking. Again, without going into the moral or mathematical structure of interest, what happened? Purely observation. What happened? The evolution of interest, and I would accredit this very heavily to kind of post-Renaissance Europe, starting with, let's say, great kind of dynasties like the Medicis, reigning all the way down to like the British kind of empire and the idea of the Central Bank of London and Central Bank of England, some things. What they did was they used interest as a tool to govern time with money. And that is the basis of the phrase that you'd hear in any economics class, which is time value of money. That is the most common concept, massive formula that everyone writes. What's the T of M? What's the T of M? What's the T of M? Right? That is kind of the function of interest, like mathematically speaking. But what's more interesting than that is the fact that what the inverse of that is that if you don't have interest, there's no time and money relationship. And that you guys don't understand, because I don't understand it, because we've now baked ourselves multi-generationally into a system where that's just not true. Their time is governed by money and money is governed by time. We obviously superimpose those realities, but it is the way that we think now. Okay, the actual, the physical manifestations of this is that people got very productive. I'm not saying that people got productive only because of this. Obviously, there were factors, variables, but what this unlocked is, in some weird way, a ultimate limitation, which is I'm governed. I don't understand time, because who understands that? But I understand money. And I know that every day I have this money, I'm paying some interest. And now my productivity can be captured into that. And that's like a loan structure, is it not? That's like saying, I'm going to lend Sal $100 because he wants to grow a tree. And that tree is going to give him some mangoes or something. And he believes that those mangoes will, when he sells them or something like that, or even maybe he already has a deal where someone's willing to get the mangoes off, he's going to make more money than the $100. And I'm saying, okay, well, I'm not skilled like you, obviously, to grow the tree, and I don't have the customers to be able to sell the mangoes. I'm really not interested in any of that. So I'm not going to be able to reward. I'm not going to gain as much reward as you off of this endeavor, because you know how to do all of those kind of specializations. You're hyper productive. What I have to offer is kind of my raw capital. And in exchange for my raw capital, I expect some of that value, that upside you're going to create, and that would be the general interest rate. Mm-hmm. So that would say, let's say I'm going to give you $100. Sally, please give it back to me within 1 month with $1. So that's making up numbers to 1% interest rate. Sal's like, great, that makes perfect sense. I think, I've shopped around and you're the best deal in town. Give me the money. So then Sal takes it. And now the 1 month and the $1 are inextricably linked in his head. And what that does is it creates this delusion that this has to work and produce the yield that he was looking for in that time period, or what, not the world shuts down, or what, maybe I'm not even gonna come after him, but there's something that is so much more prevalent than both of those things, the world shutting down and me coming after him. He starts losing more money on day 31. And on day 32, he loses more money. Because at this point, the quantitative measure of his lack of productivity is the money he's losing. And when you can define that, when you have a solid grounds for money, which throughout kind of like that time period I explained, like let's go from the Renaissance all the way until like 1950, which is maybe the birth of fiat, was gold, like a gold standard, literally gold or gold-backed fiat. So when you have stable currency, which is really gold is very stable, and then you have interest rates, that's the ingredients for the 500 years that we've just had are just like unbelievable. Like they are so ridiculously productive that it just, I mean, the last 50 years compared to the last 500 years would have been also that, like last 5 years compared to the last 50 years would also been that. And that, funny enough, productivity seems to compound. There's many theories about that, but you know what also compounds really well? Interest. And so you then defined the entire structure of human potential within this concept. So that is the most ephemeral understanding of interest that I think is like, would be bananas to someone to stumble on by themselves, but that every person you tell that to, or every person that watches this will pick that up. Zero math required, zero training in economics required. What I just said, everybody knows. They can't say it, but everybody knows, because that's how you actually view time. Consciously or subconsciously, it doesn't, and probably subconscious. That is how you view time. Now, that's not like that, sorry. I'm gonna actually now break that into the practicals. And but go ahead, Sal. What were you saying?
I wanted to know because what you're saying is that layering on interest on top of a stable currency system, kind of squeezed out the most productivity out of a certain out of people.
Yeah, I mean, everybody. I mean, I'm using. I think we can be kind of precise as to where it was formatted and where it's more popularized, which I would say is like Renaissance to modern, like definitely the British Empire is the greatest example of this. There's not even, they are the exemplary versions of like, hey, we're trying to conquer the world. Okay, that's our objective, and that came from the sky to some degree. Like who really knows who came up with that objective? But that's an objective that I guess emerged, and so that's irrelevant what the quality of that objective is. But how do we accomplish that objective? Well, we need something where when we go everywhere around the world, they're also going to think is valuable. And unfortunately, pounds didn't meet that requirement, because you go to India and say pounds in the late 1600s, and they would have said, what? And if you had gone to Latin America, which at the time, obviously wasn't even called that, and you said pounds, they would have said, what? But what everybody understood was gold. So gold already came, 2,500 years in the making as, okay, this, everywhere you go, it's like, you could have seafared around the world, so gold is, everyone kind of thought that was valuable. Perfect. So let's build the pound off of the gold. So every pound is, I'm talking about the Great British Pound, is backed by some type of gold. And that means if we can convince people of that, which actually it was very much provable that was the case, then now everybody thinks we can do business. Transactional structures are created, but that's not enough. What really fueled, in my opinion, the Industrial Revolution, apart from the actual, and I could even make an argument that there's reason for the Industrial Revolution, is because people created this concept of interest, and the pound over the gold standard, because it was stable currency, was a hell of a motivator. And again, it's so baked into your building that it's hard to actually ever even speak of. It's impossible to say, because it's like talking about why your skin color is the way that it is, or why your hair grows. It's that ingrained at this point that, to even say it, to talk about it, would be like questioning the principles on which you even woke up this morning. And I'm being a little dramatic, but not that dramatic. And so productivity is a function of how well you quantify time, and nobody does that well just on the basis of time. As you know, T minus 365, nobody does that well on the basis of thinking about it as time. You need to think about it as something else. And we all agreed that it was money. I mean, we didn't take a vote or something, I just think it happened. And so now let's express that. What it really then comes down to, practically speaking, now you guys understood kind of the emergence of the collective value, and there are few things in this world, and I've tried to analyze them a lot, like anthropologically, that let's say you go anywhere in the world, the most obscure part of the abandoned part of the world to, downtown Manhattan, like anywhere you go, I wanted to find, what are the things that are just there? Yeah, I'll give you a couple. I don't have the full list because I think it's hard to get the full list, but we know there are a couple. And what I would say about these things is they're so valuable that they've become almost archetypically biological, something like that. Clothes, some format of clothes, doesn't obviously look the same anywhere, is everywhere. That's strange. That's very, very strange if you think about that, right? How the hell did that happen? Okay. Another weird thing is kind of identification by imposition on your body. Obviously, sophisticated societies would have identification in abstract concepts like names, IDs, numbers, that type of stuff. But I'm saying rudimentary identification into imposing things on your body, tattoos, piercings, and makeup. Some version of that is everywhere. It's bizarre that that's the case, irrespective of language, culture, weather, anything like that. Bizarre. And the third thing is like transactions and some value for being some penalty for being unproductive. That's quantified as time. That's everywhere. You can go into the depths of the Amazon rainforest, and it might not be dollars and interest rates and kind of Fed funds rates, but it's some version of that. You give me a banana, you better give me more bananas tomorrow. I mean, I give you a banana, you better give me more bananas back, because there's the opportunity cost that my capital is losing. And so that it's incredible that is what it is. I mean, we don't know, again, a lot of things we don't know why they are the case to be, but it's almost mind-boggling to even observe them like that. Okay, expressed in practicality, and how you guys would probably think of interest rates, is a function of, by the way, what you think of interest rates is not actually what they are. What I just described is exactly what they are. Emergent idea is to keep people productive, and that's a very good thing. Now, come back to what we think they are. What we think they are is on both sides, right? The person giving money and the person borrowing money. You got to think always of both sides. The person giving money, what what is really is accounting for opportunity cost. That's all it is, right? And how you would account for the opportunity cost is the value of your money expressed over time, right? So, and this is really interesting because this is highly subjective. It's very subjective between countries and sometimes even subjective between like people individually, right? So me and Sal always have this conversation, which is that to people in the crypto space or people that are used to very aggressive investments, their time value of money is extraordinary. You can't convince them otherwise, right? I mean, they have now, I mean, I don't know if it's an elevation, but they've put themselves in that paradigm, which is they may say that unless I'm receiving, Sal, give me a number per month.
5%.
Okay, that's very conservative. That would be like the old crypto kind of, so unless you're receiving 5% a month, this is not worth me lending it. As in, they've defined that. That's now their paradigm. Obviously, the normal world works in what we would call like a Fed funds rate, which is what the central bank authorizes. It's kind of where we're going to get. That's going to be the end of this conversation because that's the most sophisticated mechanical version of the early, very abstracted concept I described. But even if you're talking between people, I can say to Sal, you know, unless it's 5% a month, I'm not interested in lending it. And that basically means that even if Sal is going to take my money and cure cancer, I don't care because the 5%, and I'm not making a statement on that, I'm saying it's irrelevant what he's going to do with it. That's my point, is that the 5% defines the opportunity cost. That's what the lender believes, by the way. Okay, the borrower. What the borrower is saying is, what am I willing to pay? No, the thing he's thinking about probably backwards. What am I going to make for having this money that I don't actually have because I have to take it from someone? And that has to obviously be greater than what, as soon as whatever I'm going to make is greater than the interest rate available by the lender, there's a deal happening, right? So, and make is an interesting word. I want to be careful that I used it loosely. Make doesn't mean just profit in the typical sense of like, oh, I'm going to take the money, start a business and profit and then deduct my cost of money, my cost of the actual capital. No, make can also mean just personal satisfaction. And this kind of explains, let's say, credit card debt. And basically what that is saying is that the television I'm going to buy or the trip I'm going to go on is I don't have the $5,000 required to go on the trip I'm going to go on. And so I'm willing to pay 20% like a credit card on that $5,000 because the joy I'm extracting from that is 5,000 plus 20%. That's the equivalent of someone saying, I'm going to take the 5,000, start a business and I'm going to make 21%, something like that. Because, go ahead.
If people understood that interest was basically the efficiency of productivity, then they would only take it on the calculation of if I borrowed this $5,000, then I better have an economic output that is $5,000 plus interest.
Plus something.
But if you now come to modern day times where interest is offered for just the mere enjoyment and the vacations that people might take, the output is 5,000. Well, it's not even it's not even the raw capital that was taken. It's not the interest rate, and it's definitely not a economic output that can be paid back. So that is, I guess, very much diluted now into merrymaking versus productivity, and that's why it's spiraling down.
By the way, that's why you have debt cycles. Like that's a different podcast we're gonna do on that. Like, I mean, not a different podcast, different video in this series, which is, wait a minute, if people only borrow money to make themselves more productive and they can pay it back, well, why is there like, you know, any type of fluctuation in the economy? Shouldn't it just be like a steady, gradual pace up? Of course, that should be the case. And mathematically, you could definitely validate that that's the case. But unfortunately, as soon as there is a guy that borrows money to not make it, then now you have what you pair that with a guy that's willing to lend it to him. Like, you need both parties, right? Now you have something like there's a percentage of the world that's borrowing money to make money, and then there's a percentage of the world that's borrowing money to not make money. And obviously, when those two things collide, every second of every day, millions of times throughout an economy, now you have cycles, because at any given point, one will be greater than the other, right? So like, you can say that during a boom, and obviously I'm generalizing like crazy, but like what a short-term debt cycle look like is that during a boom, more people are able to profit from the money they borrow than suffer from it because they're careless or just not capable of producing the profit. Then that's what is pulling up the boom. And then as soon as that shifts and it even goes, on the other side a little bit, now you start to experience the recession element of it. That's what a debt cycle is caused, because there is that equilibrium, because it's actually not always mandated to use interest to use debt to do something to generate more value. It's never mandated. It has never been mandated, and it's definitely not mandated today. And you can make an argument that it's not even promoted today. So, but nonetheless, as observers of it, we have to be cognizant that the majority of the world on the borrowing side has many meanings of value that comprise the money they have to pay back, the interest plus allegedly something more, right? So whereas Sal might only borrow money to responsibly make the money back, so he can actually pay it back and be a good kind of participant in this transaction, but also make the interest so that he is participating in the creation of value for the lender, and then also he's able to validate that he created more value than that for himself. And then of course the profiteering element, or maybe Sal will only do that, but then concurrently, to me, I can't afford the trip to Disneyland right now, but my kids are crying, or whatever the hell it is, and then it's $5,000 I do not have. But what I'm doing, and again, going to be an incredible sequence of videos just to explain this on another note. What I'm doing in that other words is saying, okay, well, it's $5,000 and the credit card company is going to list me for 20%. So that's basically, I have to pay it back within this year, $6,000. And then like the time value of that, even like profiteering would have been, maybe I'll put it on another percent on it or something like that. So I basically need to pay back 6,000 some change within this calendar year. My question now is this trip to Disneyland somehow valuable to me to the degree of that? And of course, the answer seems to be overwhelmingly yes, hence the precipitation of that. Now, this is interesting. Does that mean that at that point, the economy shuts down? It does not, because most people, well, not most people, let me stay with everyone is attempting to do it, and then I'll actually be cognizant to say that most people do it. When you borrow money and you're not immediately utilizing it to make money, utilizing it for something else, what you're actually doing is you're borrowing not from the lender anymore, you're borrowing from your future self, right? Because he's the future Sal is the asshole that's gonna have to pay for this. And what is he gonna have to pay with? Lack of whatever you're spending now. So if he's able to make more money in month 10, he's now more money minus whatever you just spent now. And so you're essentially borrowing now from your future self. But of course, if you just flip the money within that time, you're not borrowing from your future self. By the time you get your future self, you now have more money. And that's kind of the dichotomization. Funny enough, even though people are highly irrational and they spend money and have these horrible like debt habits, most people end up somehow through some strange economic incentive or maybe government program, or even just somehow weirdly end up actually paying for it later on in their life. That's usually not that great of an outcome for them, right? That might be like the reason they never get ahead, but we can clearly say that they somehow future suffer for it and end up paying for it. So it's that infrastructure has worked. Fabulous. That's kind of the two eras of how we think about money, right? Credit cards, how we think about interest, credit cards, mortgages, the lines of credit, car loans, as average consumers we would be using to kind of purchase this. Maybe if you're a business owner, you're looking at corporate debt, stuff like that. As a lender, you have these instruments that you can lend to. Fabulous. Now, I basically expressed ephemeral, like kind of humanity's conception of interest that probably nobody can articulate because it's so baked into our subconscious. Then I've expressed how interest would work between two humans. And I've expressed archetypically, one is responsible, one is not responsible, one is using it for this, and kind of we get it in isolation. Now, the most interesting thing happens is when this interaction that's happening, and obviously in isolation, is concurrent with thousands, at this point, hundreds of millions of other exactly similar transactions expressing varying results to some degree. What ends up happening there is, again, economists would call it something like the net rate. Like what you're looking at then is now you're trying to create standards, and standards imposed never go well, meaning like someone saying something like, and this is why interest I think is actually a phenomenal way to look at life, like someone coming to you and saying the standard for interest in the United States is 15%, something like that per year. Okay, that sounds great to some people, not great to some people, maybe great to the lender, maybe not great to the lender, whatever it is. But what we do know is that he pulled that number out of his ass. Now, that actually very rarely happens when we're talking about many concurrent transactions in an economy. It happens a lot one-on-one. Tremendous amount of times people just kind of make it up. But when you kind of average out those randomized transactions, you get what you would call you would get something like a consensus interest rate. And the consensus interest rate is used to be very geographically isolated. Like if you lived in the Macedonian hills, like you probably had no correlation. Like within your community, you had a consensus interest rate. So basically average value for borrowing money was, let's say 5%. But then if you lived in Mesopotamia and you don't even know what a hill is per se, you would obviously have some rate that makes sense within your kind of colony that had nothing to do with that. But of course, as we continue to globalize, now it's almost perfectly correlated in that sense, right? That there's almost a global emergent consensus rate. And the most authoritative figure in that process is the Central Bank of the United States, which again, I'm not going to dive into why that's the case. That's another podcast, but let's just say that they are. And so what they represent, again, I'm not saying this is what they do. I'm saying what they represent is almost like the lowest interest rate possible, because that's going to be what the bare bones average is, like when you consider the entire gradients of that. And so nobody will essentially and will ever lend money as cheap as the Central Bank of the United States does. No other central bank, no other government, obviously no other corporate entity, obviously no other family or friend, impossible. So again, irrespective of what they do and what they kind of, who they are, and completely irrespective of that, I also feel bad of even using them, because I think that then creates kind of it brings about your presuppositions about them. I just think about them representing the lowest rate. And maybe you don't even need to think about some. Maybe you just think about some godlike oracle in the sky that you just Google and it tells you this is the real rate when you aggregate millions of transactions, something like that. Now, why is that important to have something like a universal consensus rate to at least define the floor? And of course that changes, but they're defining the floor. It essentially now allows you to, as a lender, as a person that's deciding between being a lender or being a borrower, because you're one or the other, it's going to decide which side you're on. That hierarchy of interest rates, starting with the lowest at the central bank level and then floating down into what your brother's willing to lend you $5 for, that all of that hierarchy is what's going to make you either a lender or borrower. And I'll give you an example. The concept, and if you listen to kind of central bankers all over the world, and as they have weekly press hearings and nobody listens to them, and people really should, because they're really important, and again, probably the most important thing in the world, actually, they're doing. So, like if you listen to the weather more than them, that like shows you kind of like how much you A, trust them, and B, don't really give two shits about how this works as long as it works. So the most interesting thing is that there have been times, based on the maneuvers of this hierarchy, starting with them, where more people become lenders and more people become borrowers, the same people that diverge. So how does that work? Because one would think that you're a borrower because circumstantially you're a borrower at that given time. And like, some crazy, like a very typical is like, you should lend money to people in need because something happened to them in their life they didn't control. Okay, great. But that would never explain what I just articulated as a common thing, is that in economic cycles, there are many times where the same human under same circumstances is a lender and a lender or a borrower. That's completely based off what we would dive back as the real time value of money. If the time value of money, which is defined individually as the interest rate between two people, but defined generally as the central bank's interest rate, because nothing's going to be lower than that. That's the lowest, that's the cheapest value of time you're ever going to get. If that number is XYZ higher, lower, that's what's going to determine whether it pays to be a borrower or it pays to be a saver. Because there are tremendous amount of circumstances today in the world, depending on how the central banking policy in your country transpires, but also historically in almost all experiences, where it does not make sense to be a saver at all. At all. It's so lucrative to be a borrower. I mean, you'd argue that that's currently the status. You can very much argue that it's a modern monetary theory would kind of create that to be the concept. And what do I mean by that? That basically means if the interest rate, let's just say, like now let's talk super practical. Let's just say the central bank interest rate was, like in the 70s, like when it was like I would say like late 80s, where it's like 3%, which is mind-bogglingly high compared to what it is today, which is like less than a basis point, like in that range. So it's 3% is hundreds of times, like if you think about that, right? So what that means is that that's the cheapest value of money you're going to get on planet Earth, and nobody really has access to that. Like no normal person has access to that. So your value for consuming things is expensive for money you don't have. In other words, you could spin it to what Sal said. Oh, if I'm borrowing money, I better have a plan because money is really expensive, right? And so what that does, and on the other side, it says, oh, wow, it pays to not divulge, like to burn your money. It pays to not burn your money. In other words, if you tie back to the game I said, don't do rule number 1, do rule number 2, works. That's what makes you a saver, right? And rule number 1 is what makes you like a borrower, a spender. And essentially, the interest rate determines that. Manifested super practically. Let's say mango example, because I think we were all farmers once upon a time. Mango example, the weather, the harvest, the elements of the natural world restrict me to only being able to grow 2 mangoes per tree. Somewhere, I have no concept of agricultural numbers. I'm just making like a oblivion. 2 mangoes per tree. That's been the case since mangoes came about, something like that. I'm going to say we're going to just define that as an assumption. Okay, so that unfortunately I don't have too much ability to change. What I can now change is, and so for me to grow another mango tree, start another mango tree, it's going to cost me $100, random number. 2 mangoes are able to sell. I can sell, like 1 tree produces me 2 mangoes every week. So I can sell 2 mangoes every week. Let's just say I could sell them. So I can actually have customer bases there to some degree. Obviously that's a variable as well, but let's just assume that that's the case. So that basically means that I can sell 2 mangoes a week. That's 8 mangoes in 1 month on a 4-week month. And the going interest rate is $10 per month, so 10% per month, which means that if the mangoes are priced at anything less than $1.20, there's nothing to happen here. Now, it's interesting that people think that you could just change the price. Why would you make it more expensive? That unfortunately actually doesn't happen. Interest rates making things expensive, really uncorrelated. What makes things expensive is kind of supply, like demand curves on that. What interest rate does is change the degree to which people borrow money. And so now, this is the fascinating part about all of this, is obviously there's direct things get more expensive as more people have surplus. I mean, I'm just saying directly. The direction here is that if they lowered interest rates, I can get more trees. I'm incentivized to now go and borrow. So, and I'm using it for productive reasons. I could easily just also use it for unproductive reasons if that Disneyland trip works, whatever, right? So in other words, you're going to make almost all decisions like this because very few people can find investment opportunities that are that much greater than kind of the average debt rate. I mean, it's almost like negligible. And I know we all think we're Warren Buffett, but it's almost negligible, right? You can almost write off your kind of unique genius to finding great money-making opportunities. And if you are one of those people, then you're actually one of those people. And almost in the literal definition. So the average person is going to yield somewhere close to that and pay a derivative of that, right? That then governs, is there more borrowers? Is there more savers? And more importantly, this becomes the final thing that I'm going to tie off with because crypto lands right here from a problem standpoint. This is the problem in crypto. Obviously, crypto solves many problems, but this is the problem. When you are a saver, i.e. a lender, savers and lenders intertwined in kind of modern banking. When you are a saver, i.e. lender, because it's incentivizing you to do so, there's still a couple issues here. Number one, it's not free to keep money. And let's rudimentarily say that that's just bank fees. Or if you're keeping it in your bed, whatever safe you bought, like there's some storage cost, right? It's usually negligible, but
Right.
that exists. So again?
Inflationary cost?
And inflation, something else, but I'm talking literally just the storage cost, right? Like you're keeping, like literally, and it sounds funny because you don't think about the bank fees you pay as smart, or if you bought a safe, it's a one-time payment, but it's not zero. And I'll tell you why it's important it's not zero. The reason you don't give two hoots that it's not zero, and Sharpen it's like whatever it is, it's even, let's say it's 1 basis point on fees at Kate, storage fees or whatever it is. Obviously no one even thinks about the storage fees, but like you get my point, is that the issue is because there's time value of money. And the time value of money is nowhere close. It's so gargantuan compared to your storage costs. Even the shittiest interest rate you're ever gonna get is gargantuan compared to your interest cost. That's actually, I mean, compared to your storage costs. But what is the time value of money with zero? Now, any number greater than zero for storage costs means keeping money in with you is losing you money. Minus inflation. I haven't even gone to inflation. I'm saying like it's only negligible. Storage costs only negligible because there is interest. Now, inflation. What a fabulous topic. I think inflation, by the way, is the second most important thing about money. Like,
Interest?
yeah, money is the most important, like money is the construct, like let's say the fiat currency that we believe in today, and interest is by far the most important thing. And then I think this concept of inflation, deflation, which is derivative of interest, is the second most important thing. It deserves like, no one, I'm appalled that people don't actually get inflation because it's easier than interest, I would imagine, to get, but again, different subject. But I'm not even accounting for inflation. Let's just say the government's not printing money. Let's just even assume that, which is not a safe assumption. But assumption being one, you no longer, it's the moment interest rates go to zero, keeping money is irrational.
It sounds like borrowing money would be the way to go.
Becomes very rational. Because let me just explain it to you. Someone's gonna pay you to borrow it.
Pay you in terms of you making revenue and profit?
No. Listen to what I just said. Someone is going to pay you to borrow their money.
But if it's 0% interest, how am I getting paid other than my
No.
economic output?
Just come to my point. As soon as the market goes to zero, there's no interest. I still have a storage cost as the holder of money. Let's say the storage cost is tiny. We already agreed it's tiny. Let's just say it's X. That basically means I'm willing to give you this money if it's less than X. Like, I just have to dump my money at that point to somebody, because as soon as you get the money, you have to pay the X. Do you get my point? Even holding money becomes irrational, let alone inflation. At that point, it's a joke. And this is a really interesting concept because the world, since the conception of interest, has actually never gone to 0% interest, at least collectively. I'm sure it's gone in some pockets of the world. Collectively, never. We are there in the real central banking world. And if you watch economists, and I'm not saying they're very bright, I actually make fun of them a lot, but if you watch economists, especially the ones that are very vocal, they're always talking about the inverted yield curve. Look, we're gonna zero interest rates, and look at the interest rates are so low, should we increase them? And okay, I mean, they're like cherry picking a day, like, oh, it's a 1 basis point up today, and like, what's the Fed gonna do? It doesn't really matter. What we're not saying is money is the time value of money is almost zero. It's still, the United States has some positive rates. Europe is in negative rates. That's a concept I don't understand. I've tried to understand that so many times. In Europe, they pay you, not you as a human individual, but like an aggregate wholesale kind of liquidity player. It costs you to hold money with the bank. It costs you money, not storage costs. We already say that's the case for anybody, even if there are interest. Europe is negative interest rates. Japan has been almost negligible interest rates since obviously the 1980s. The country that upholds time value of money in the real world today is the United States, and they're very low at this point. I mean, this is the big thing. It was like, what we're talking now with the coronavirus, and the United States going to go to zero, and the difference between zero and 0.0000000000001 is not that number. It's colossal. Because once you go to that, once you get in there, now we don't know. We actually don't know. We don't know what the world looks like. Well, we know what kind of pockets of the world looks like. It's not good, but it's unbelievable. Sorry, yeah, go ahead. Before I go to crypto, go ahead.
Well, yeah, so I wanted to know, because as you were mentioning, if Europe has negative interest rates,
yes,
Japan has negligible interest rates.
Negligible, yeah. They've had negative ones too, yeah, but yeah, right now.
Negative or negligible?
No, they've had negative, and it's just it's not. Nobody goes to the JPY for interest rates. Let's say.
Oh, okay. And perhaps I know Japan might actually have quite a thriving economy over the U.S. I don't know about Europe versus the U.S.
Yeah.
But U.S. is not doing that. But my question is this: does economic efficiency and output increase or decrease with greater or decreased interest rates?
So, okay, you're asking like a central banking question, and so I'm going to answer it as like a central banker, but that's not like conceptually the correct answer, but I'm going to answer it practically, right? So if you're going through a recession, meaning something happened, a great example of a random event happening is coronavirus. So it's not even caused by kind of the people that are partaking in this economy. Some crazy shit happens, 9/11, the coronavirus, something that's just out of the blue kind of, and you can't really pinpoint on the people can't punish anybody really for it. So now like something like that happened, now you're the central bank, like, oh snap, cracker pop. There's a demand side shock that we didn't account for, that who could have accounted for. And now people are slowly regressing to spend money. And what is the eventual reality is, wait a minute, the guy that borrowed the money to grow his mango trees lost his customer. And although his interest rate made sense when he borrowed it, and it made enough sense for him to borrow it, which was the first premise, it had to do that, or else there was no mango tree, and there was no mango customers. But there was, because of the interest rate, a mango tree and mango customers. But now for some crazy reason, the mango customers were no longer interested in mango. That guy, even with the rate that was made sense enough for him to borrow, no longer, he has to default. And that's the idea of a default, because the rates that made you confident to borrow your mortgage or whatever it is, no longer make sense because of the demand side shock. At that point, a central bank in modern terms, like what we now know as a modern central bank, supposed to say, oh, that's not good, because if everybody starts defaulting, this is not just going to end in a slight demand side shock. We might have what you would call a currency crisis, a capital crisis, because now everyone will stop. It's essentially the capital markets freeze. And this always happens, by the way. If you looked at the coronavirus, the first kind of the most prolific, the 2 weeks kind of when people woke up in the United States like, oh, this is not like happening in a random province in China. This is happening like here, and it's going to cripple the US economy. What first immediately happens is that the most speculative class of capitalists, which are obviously people that are hedging and kind of trading, are going to say, oh, this is like news, and like, let's chill out. And as soon as you start chilling out the capital markets, everything starts the confidence of the consumer, everything's correlated. But what it comes down to at the end of the day is the business owner or the person that borrowed money now doesn't have the means to pay it back, even though he did. It is not like it's not like he made a bad borrowing decision, although he might have. That's not empirically true here. He made a valuable borrowing decision where the productivity would have paid for everything, and exogenous factors hit him or hit the economy, and now he can't even pay what he agreed to pay on. And the central bank says, no way, Jose, this is not why we were built. So what we're going to do is we are going to drop our interest rates. And of course, the poor guy that borrowed the mangoes from the local lender who gave him the money to borrow the mangoes, that local lender is deriving his interest rate some level division away from the central bank's interest rates in his country, let's say. So as soon as the central bank drops their rate, like concurrent institutions will do the same thing, and some of them are regulated to do the same thing, but it almost happens also, if it happens kind of a market principle too, it starts to drip, because people just fight off each other's debt kind of collateral, right? So it's like drip, and now the mango person is at least not defaulting. That is the goal of a central bank, like to make sure that their lever of lowering interest rates and then what happens is, as interest rates lower like that, people that were not borrowers before become borrowers. Thus now the entire stimulation happens when they lower interest rates. So that's why they do it. In a time of economic crisis, the goal is, let's print money, let's lower rates. Printing money gives demand side shock if we could get it into the hands of people who are going to buy shit. And then lowering interest rates means people are not going to close everything, because obviously it's constructed on this time value of money, all the debt and kind of the way that we function today. And so that's the job of a central bank. The issue, of course, and this is what maybe like a Frederick Hayek or like a Austrian economist would say is, although that sounds like a great idea, how do you plan on rescinding that trick that you just pulled? Because, okay, so the economy then starts to rejuvenate itself, as it does always. Are you going to increase interest rates? And of course, like a central banker would say, of course I'm going to increase interest rates. Really? That sounds like a great idea, like that you are going to increase interest rates. But what we find usually is they don't increase interest rates for various reasons. Number one, nobody wants to slow down the economy. No, irrespective of how fast it's growing, irrespective of how many concurrent years of growth you've had, irrespective of how far away from the last recession you are, it's not easy to even reduce the iota of an economic growth by a fraction of a percent. Trust me, the political party in power is looking at the central bank. In the case that it's like the United States, where they're actually separated. In most countries, it's not. It's just they're one party. And they're saying, you want to do what? You want to increase interest rates? Have you lost your mind? Like, that's going to basically get me out of power. More times that actually absolutely happens. Okay, so then the question is, Sal, yes, it's a great tool. It kind of jumpstarts the economy. It gets people in the groove of borrowing, which gets them in the groove of further stimulation. Got it. But do you have actually ever the ability to rescind that policy and increase interest rates back to normal? In certain circumstances, it has happened. Germany has done it, like where the interest rates kind of normalized, and the United States has done it actually several times. But what we do know is that after the Great Recession, it has not happened. Interest rates have stayed pretty low for American standards, like terribly low actually. And so just think about it like this. Before coronavirus, Europe had negative interest rates. Just that is the petrifying thing, right? It's not like because of coronavirus, we went into negative interest. The United States might be able to do that. They should, but they could say that at least. But there are countries that and for those of you that don't know, between 2009, like post-crisis, and 2020, this has been the greatest economic boom in the history of humanity. Wow. Like, it's not even close. I mean, the only comparable one is post-World War II, like the Truman years. And maybe you can say something like real GDP is more greater during those years. Fine, I'll give you that. But in terms of asset prices, oh my goodness, it's bananas. And of course, for those of you old enough to remember that, and I hope that most of you don't remember that, because it was such a almost in functional collapse of everything we know. But for those of you who remember that, you remember how low asset prices were. I mean, you could have went to Detroit and bought a block for a couple $1,000s. Or I remember, I was watching the other day, actually, in preparation for this. I was watching when, I think there was an election year, so 2008, it was the year that Barack Obama won. And then, so like mad election news going on. And at the bottom, it says something like S&P 500, $300. And you're just like, what? And that was in 2009. That was a short 11 years ago, or so $400, something like that. I'm like, what? Are you kidding me? Like you couldn't even imagine that to be the case. And so for what happened in the last 11 years, if you owned assets, you got filthy rich. Now, I'm not saying it happened to every single person. I'm saying overall, right? But I mean, think about how much the entire kind of asset class of whatever real estate and equities tremendously, and even corporate debt.
No, this is by far one of the most, actually perhaps the most in-depth conversation I had about interest, or one of the only conversations I had about interest other than compound interest, which is of course the sexier upsides of interest.
Well, compound interest is a destructive weapon, like for the person who's paying it. Like, I mean, it's a like, what did Einstein say? Einstein's famous quote is like,
Wonder of the world.
the night wonder of the world or something. It mathematically, I mean, if you're not an economist and if you don't think about money, compound interest is a crazy idea just from a math perspective. And then most of the time, compounding stuff is very destructive. Let me give you the most clairvoyant example. Do you know what compounded in the last couple of months that, you know, kind of took the world by storm? Oh yes, a virus. Typically compounds really well, right? For one person that gets infected, infects 3 people or whatever it was, that's 300% interest rates on every single person, essentially, the virus was getting. The only time compound interest is phenomenal is if you're kind of you're so effectively allocating money that your capital is compounding. I mean, first of all, congrats. You're not getting rich. You're like breaking the laws of like getting rich. You're getting so rich so quick, it's bananas. That might not feel like that because it's a small amount of money you might have, right? I mean, I get that. But if you just ran the numbers, it's just unprecedented. On the other side, however, think about what's happening. Just think about, imagine like that kind of, that carnage that's manifesting into the world. I'm not saying, again, we're not making any statements on it. It clearly works to some strange equilibrium. But we like Sal just said, you can only think about one thing at a time, and you usually only think about your position. So you go to the bank and you're borrowing money on a credit card. That's all you're thinking about. You don't think about how this actually. You don't even think about where the bank. Like so many things are going on there, right? And on the other side, you're making compound interest through this very clever investment product. Sounds great, and that's probably all you have the capacity or the requirement to think about, and doesn't kind of elaborate out everywhere. But the reason it's important, and Salah, I'm just gonna take your point and bring it into the most important thing. The reason I talked about zero interest rates and that not being a number, that being a threshold, is because that's what we have in crypto.
We have 0%.
That's what we have in crypto. That is all we have in crypto. And here, in my opinion, is the most, I could call it bizarre. I could call it the most incredible opportunity I've ever seen in my life. Definitely not short term. And number three, and the most outstandingly underrated topic and notion about crypto, which is, wait a minute, am I paying to hold my crypto? Like, is it costing me money to hold crypto? And the answer is, of course it is. There's no time value of crypto. And then you're like, wait a minute, that doesn't make much sense as to why so many people want it. Of course it does, because the asset's still very volatile. So it's like rooted in, and very much you can make an argument that it's volatile because it doesn't have time value, but that's a different, that's actually should be, that's probably next week's podcast, which is what makes something volatile like crypto. But what we do know is that one of the elements that makes it volatile is that nobody has an incentive to keep it. And so the only incentive you have to now is to speculate rapidly. And when something speculates rapidly, it creates volatility indexes. And so, I mean, it manifests itself over a very a vicious volatility index. So this is my point. I want to leave you guys off with this. Crypto is not a currency on the fundamental basis that it doesn't have interest. Now, that doesn't mean that every currency has interest, but I'm saying it's not a currency like what you think of a modern currency. Number two, crypto costs money to store. Like, I'm not saying it costs that much more than fiat or that much less than fiat. Well, we do know it's not free. I mean, like, however you want to look at it, it's not free. Like, whether you want to look at it as hard drives and somewhere sitting in Coinbase, or you want to look at it like literally the fees you pay to your wallet provider, your exchange, or however you want to dice and slice, like, because it doesn't literally manifest sometimes as, hey, this is the cost of your safe. It doesn't look like that all the time. It looks like it's kind of built into a thing, but it costs money to store, so it's not free. So it's basically costing the holder of crypto money. That's very clear mathematically. Number two, so now that's number two. Number one is that time value money is nothing. Number two is that it costs you money to hold it. And then number three, and I think this is the most interesting one, is that if we get this right, it's almost impossible to predict. Like, can we get it right? But we know that we can because we did it with fiat. But if we get it right, this is not fiat. This is the gold standard. So Bitcoin perfectly, and I would say better than gold, took the characteristics of what I started this conversation is the British needed what? A stable currency, gold, right? So that everywhere they went in the world, it was that nobody had kind of power to mess around with gold. And that's still the case to be true. You can you can mess around with gold prices, but that's very different than messing around with gold. So my point being is we went away from the gold standard in the 50s to go to fiat. And I think because of the amount of financial instruments, the largest being interest, money markets, because of that, I can subsidize the volatility to some degree. Like it subsidized, I mean, by the way, clearly it didn't subsidize the volatility in countries that have really volatile currencies, right? Like that have not good currencies. And the United States is not one of those. That's because kind of maybe the time value of money is sustained. I would say that this crypto is already done the gold thing. It's done the perfect, stable, immutable currency element. The only thing it's missing, or not, I can't even say the word only in front of this, the thing it's missing is a time value of money system that is as decentralized as the function of the money, that the function of crypto being money, which is, as you know, very decentralized as a basis of it. So first of all, and I'll leave it about to start with this. The thing that would shock you with this, holy smokes and holy crap, wait a minute. It is really weird that crypto doesn't have any interest rates on a generalized basis, on a way that is emblematic of the very nature of crypto, it's decentralized, and what's the real value of crypto, time value of crypto, not the price value of crypto. So that's insanely strange. Number two, you're losing money to hold it. That's why you keep trading it. I'm not saying you keep trading it. That's why people keep trading it. And number three, so the first part is, wow, we need to fix this problem. And the second part is, if we fix it, you are talking about, I mean, it's unbelievable what could come out of it. I mean, it's a crypto with real decentralized time value of money, with something that is as immutable and that doesn't have prejudice in the notion of like typical currencies would have prejudice to be like in a specific country or to be accessible to only specific people, has no prejudice. Now you're talking about essentially giving the two most valuable ingredients of productivity to every human on planet Earth. And so that's kind of where I would end off today. And I would say that sets up the class for what crypto can do.
It's some points in regards to that last point, which is in order for crypto to even fathom having the introduction of interest, it would need to be a non-volatile currency. It would need to overstep, I think, what is one of the most amazing elements to it that prevents the economical casualties that we see in fiat, which is not just no interest, but the other side of that, no debt can be created on the other side, and that can be a pro or con.
Yeah.
But in order for you to gain interest or have time value of a non-discriminatory type of currency, which is very much needed, but you destroy I think the fun of the volatility of crypto.
Yeah, absolutely. I mean, so to address that point, it's not that you need a non-volatile currency to create interest. Clearly, no interest has come from a stable currency because that couldn't have happened, right? So it's like what you're saying, what you now need to say is enough people respectfully honoring interest makes something stable. That's true. That's what stabilized fiat currency, or some fiat currencies. And these currencies that are not stable have the exact requisite for failure in that sense, right? So it's like, think about it, right? If a country defaults on sovereign debt, I mean, like many things can cause a currency to be very volatile, right? But the greatest and the most obvious thing, that way you don't have to look into the underbelly of the economy, the most obvious thing is that the entity that printing this money doesn't pay its debt. Oh, this is not going to go well for us lenders. And so they run from that currency as fast as possible. And so what we're almost saying is that the evolution, so Sal, this is what's interesting about volatile assets, is that obviously there's interest on volatile assets. It's just not efficient, meaning nobody agrees on it. And when nobody agrees on an interest rate, guess what happens? tremendous amount of people will default because nobody's getting the price that makes sense, right? Because like you don't know what the value of money for the dollar is. You obviously have no clue. In order for you to know that, you need to, at this moment, analyze every transaction happening. Now, maybe we could create some algorithm that could cause that. That would be very cool. But I'm saying is you outsource that responsibility to the central bank to kind of know what that is and to define it. My point is, if you didn't know and there was no entity to define it, now you're talking about a world where what are the chances you're actually going to make a good borrowing decision? Because your price reference is now, you have nothing. The time value of money is just case by case. And that is crypto. So I do want to correct myself. It's not that there's no interest on crypto, it's that nobody knows what it is. And so everyone makes up their own if there is any to be made. And of course, when everybody makes up their own, many people will default because obviously they didn't get the right price. And of course, since they didn't get the right price and they default, you have very volatility, volatility because it doesn't pay to hold. I mean, at the end of the day, if something doesn't pay to hold, it's going to be traded often. Like, let's think that's the first basis. What is someone paying you to hold Bitcoin? Nada, obviously. In like, if someone's paying you to hold Bitcoin, if no one's paying you to hold Bitcoin, then the benefit of you keeping it any moment more than what you feel to be a speculative function is irrelevant. And that, by the way, some people's speculative function might be 10 years, so they might keep it for that long. But that is why, if people used to listen to my old kind of like global exchange webinars, I'd always say that the total market capitalization of crypto, let's say, is $200 billion. I don't know what it is today, maybe a little bit higher than that, 200 billion. And if you looked at the total trading volume, it's like $80 billion in one day, which means what? I always said this, that almost 1/3 of crypto moved in the last 24 hours. That to think about that for 1 second, can you imagine 1/3 of every dollar moving in 24 hours? I mean, there's $21 trillion. Like, it's unbelievable that would happen. There's no asset, or 1/3 of all Apple stocks moving. It's unbelievably volatile. And the reason for that is because nobody's paid to keep it, not even by a day, not even by a second, more than the rational equation to sell it. And most of the time that's irrational because they're afraid, so they sell it. I mean, that rationality and irrationality will make up kind of sell prices. But the point it's like an asset being that traded can't ever become not volatile. It's impossible. And so how do you prevent that from happening is you incentivize people to hold it. And by the way, and we're going to explore this in great detail, because I think as we manifest ourselves out of understanding the current market of crypto in juxtaposing it to what I talked about, we're going to now get into, is the traditional model of interest, as you said, that creates debt, is that the only way of creating time value of money? That's a fabulous question. And already in crypto, they've disproven that to be a reality by the invention of something like staking, by the invention of something like mining, where staking is a fabulous example of time value of money without creating debt. So, right? So already you've been able to break that mold, probably because the programmatic advantages to crypto, the fact that you can configure it so much more than you can configure a dollar, for example, allows you to at least be creative. And I think that we will be creative. I think there's going to be so many bursts of creativity, but the first thing is to understand that the makeup of that, and then also to say that some interest rate's going to be there. It has to be there. But can we always augment it so that it's not so vicious or something like that? I think this is where we're getting to right now, which is, people talk about, when is the crypto market going to become mainstream? No currency ever becomes mainstream without interest. Yeah, and not even, I'll tell you what's not mainstream? The chicken that you, like, me and my brother used to always barter like fast food, right? So like he would get fast food one day and like I wouldn't have any money, so he would give it to me, and then like the next day I would have to give it to him. Like that type of stuff never goes anywhere. That's why we don't emerge that as kind of global currency. And the reason for that is because it's almost impossible to calculate interest on that. The dollar became the instrument of interest calculation in an almost immaculate perfection for fiat models. And so the question now is, if crypto is to go mainstream, and I just explained to you that for the better half a millennia, and for damn sure since the proliferation of fiat currency, the human mind, not the American mind, not the Chinese mind, not the Russian mind, not the male mind, the female mind, the child mind. No. The human mind thinks of time with money. And crypto doesn't even present that. How could you even imagine someone would adopt it? Number two, it's volatile, not volatile. And so then only the kind of temperamental risk takers, gamblers like us, where that's us, absolutely us, are going to have a temperament for. A normal human wouldn't very much, definitely would not take it. It doesn't make any sense. It's irrational. It costs money to store. It doesn't make you any money, apart from speculation. Most people are not speculators. So when we want to say crypto to become mainstream, we want to adopt that. The one thing people always bring up is volatility, volatility, volatility. That's a function, that's a result. You can just sit there and make something not volatile. How do you make something not volatile? Like, there's like a bizarre concept you would think of. Like, imagine there's like a tornado or something, or like weather volatility, and you're like, let's just make it not volatile. No, you have to go do some other ecological functions to create the lack of volatility. I mean, it's like volatility is an expression of uncertainty. And that might be the greatest, one-liner to end that on, off with.
No, this was definitely a conversation that has sparked a more of an accountant-like mentality in me to look much deeper into this kind of a fabric of the economy that is unseen until you are on either ends of it.
Yeah.
Until you have money to lend, or you are borrowing money and you feel the impact of it.
What I find astonishing about that point is that I would think so. I would like to believe that you're correct. Mm-hmm. Like, even to this day, I think I want to believe that you're correct. But I just never see that play out. It's almost like, you know what? It's strange, right? I mean, there's this concept in like courtship, like the late medieval ages, is that everybody hates the king until you become his favorite, and then now he's the greatest king in the world, type of thing, right? So, what I see is that like everybody hates interest, of course, until they're the ones earning it, and then everybody loves interest, of course, until they're the ones paying it. And in a very complex economy, you're doing both a lot of the time. And so, what has occurred to me is that it doesn't even take for you to hit extremes. It also doesn't even take for you to participate. If you have this conversation, you feel it. And then it's really weird that everybody doesn't feel it. Like, it's become super strange that, wait a minute, how did I not feel it 5 minutes ago when I'm paying a shit ton of interest? And also like being like kind of like the benefactor of the dollar. By the way, let's just be very clear here. And this is again, another concept that I can't go into detail because it's a hell of a concept. The dollar is interest. Like you're earning interest on the dollar. Like, that's all clear. That's kind of what I covered today. The dollar itself is interest because there's a time value of not being in rupees. Think about that. You got it. And so the rush to a currency, the rush to an asset, is of course based on the interest that asset's going to own, but it's also based on the horrible circumstances that your asset is imposing on you, which is creating a negative. Like, even if that gets to neutral, right? Like, the dollar is neutral. It's not even like neutral is so much better than what most people have. Like, that's what we have to remember. Neutral is a hell of a lot better than most people have. So when we say something like you need to examine things like, we're already, like, everybody on this call, I believe they are dealing in dollars to some degree. Dollars, and I'm very skeptical about euros. I would say like dollars and probably to some degree still pounds are still benefactors of generalized interest, and of course the interest that's being gained on the money. So we're the most sophisticated and the most kind of great examples of interest, even if we're not good with borrowing money. Like, let's say you have some bad spending habits, you're still probably better, because what's the worst scenario to be in is being in a shitbag currency where interest rates are high. And I could name you like five countries off the top of my head. I can give you like this. I would probably say that list gets to about 50 if you thought about it and thought about it. And so that, like, think about running crypto. Like, you're now in crypto, you don't even have currency, like a discrepancy like that. You don't even have like, well, you can only use Bitcoin. Just think about that. Nobody has ever said that in crypto. Right? Oh no, you can't use Ethereum. First of all, who is that person saying that? Like, nobody even has the kind of the imposition to say that. Like, because usually the person like saying that is like an exchange owner. He wants you to get into Ethereum. He wants you to trade, right? But in the real world, that is absolutely the case. you don't get access to currencies. You don't even get access to the interest of currencies, right? And so you're now looking at something like, oh my God, that's what I was really thinking about, the fact that, like Satoshi Nakamoto, and then obviously a lot of the other kind of thought leaders of Bitcoin, and then the people that really practicalized it, miners and people, even speculators played a great role in all of this. Like, they did something so insanely impossible, like as close to impossible as you're ever gonna get. And sorry, there's a mosquito. And so they figured out so many problems. It's unbelievable. Like, how do you have a global currency? How do you make it so there's no double spend? How do you make it so that there's no central party? How do you make it so that if someone wanted to attack the network, what is the 51? I mean, they thought of so many things. It's unbelievable how many problems they solved. And that is way more than they should have done. And like, and in that regard, the next evolution of crypto, the crypto stepping into its greatness is baked in all of us, because we're not that brilliant to create something that can even give the structure of what crypto is. But now that that's done for us, we don't have to do that again. We all participate in formatting the time value of crypto. And ladies and gentlemen, that is the real cost of money.
Wow.
Yeah, by the way, I feel so bad for everybody watching. This is like the most boring, like, in concept of like, if you don't feel this, and unfortunately, I don't know that everybody does feel it, because like, I felt it. I think you can even see it 5:30 in the morning. So after, I can't stop thinking about this. Like, but if you don't feel this, then this is just gibberish, even if you're smart enough to understand it, because it's kind of like, it works so well. Like, I think one of the things I wanted to get across on this is that, like, we don't have a dysfunctional system in terms of fiat currency. We just stumbled on something way better, like colossal, like it is gargantuanly better. But the point is that, like, I can understand why fiat works well. Like, it probably isn't going to explode. I mean, that doesn't mean it's not working well now. But the reality of the circumstances, in crypto, we now have that opportunity where the structural issues that came with fiat don't even exist. It can't exist. And so I think the real next, I mean, I don't know what the time span is, but next X years in crypto, could be 5, could be 50, is going to be solving and agreeing and emerging this concept. And as soon as this concept that I articulated is functional to some degree, there you're going to have the destruction of volatility.
Well, definitely it starts with this sort of spark in hopefully everyone that has at least gained some insight from it. I know myself, it just has awoken me to like, wow, this is such a profound factor. It's such a, I'm a fish and I just discovered water of the economy, and to know that this is how it operates. Oh no, just as we were wrapping up, why did you do that, Martin? Why? No, he asked, crypto to the masses because they cannot understand and touch it. Yes, in the Western world, most transactions are digital, but at some point, everyone in the world has physically touched it. Therefore, they mentally place no value. They mentally place no value on it. I'm guessing crypto. The paradigm shift will come when everyday life transactions by crypto become a real benefit to the masses.
Yeah, so that's actually a great, like, but the issue at that point is that it's true. It's just, it's not possible to solve that problem. Like that problem is not, okay, I think he talked about two things. One is kind of the cash element, because I think people associate cash with money. Okay, I'll give them that to some level. Obviously, people associate cash with money. Not really. I don't think kind of people born after the year, it's difficult to say. I definitely say people born after the year 1995 and in kind of developed banking infrastructures don't even really think of money as cash. I'm not talking about crypto. I just think their life is like that at this point, especially the WeChat generation in China, which is a lot of people, just run the math on that, right? So now you look at that and say, like, okay, is there a way that we can kind of cashify crypto? No one's ever asked that question. That's an interesting question to ask. Okay. And then on the other side of the thing that he said is that, can you use it on a day-to-day basis? Okay, that sounds fabulous. I would love to use it on a day-to-day basis. And then, I think people have very shallow perceptions on this, which is like, okay, we're going to build something we're going to build some technology that's going to make merchants accept crypto for apples. Okay, that's great. Technically speaking, that's very easy to do. Technically speaking, that's already there. That's not changing anything. That's like saying like, why isn't it happening? Like like why isn't it? Just kind of like saying why isn't it happening? So Sal touched on it. It always comes back to this volatility. It does not matter if there's Stripe and PayPal and the greatest banking system in the world and everything phenomenal. It's if the US dollar fluctuates a couple of sigma points greater than what it does now, trust me, you could shower them in interest. Like it's unbelievable how much volatility makes people not use something, right? And so there touches the point, right? So then maybe a more in-depth conversation would be like, okay, everyday transactions would become legitimate as soon as you have a stable cryptocurrency. Okay, then potentially that's the case. How do you get a stable cryptocurrency? Do you just say stablecoin? We've tried that. And the only people that use stablecoins are people that are still speculating. And the reason for that is we know deep down inside, and I think that very few people actually understand how stablecoins are not stable. I can explain that on another call, but it doesn't matter. You don't need to understand that. You just need to know that it's not, and you know that it's not. And the reality of the circumstance is stability comes from the time value of money syncing up. Like the massive amount of lenders and the massive amount of borrowers come to agreement on a time value of money, and that stabilizes the currency. Of course that fluctuates because we're talking about a lot of people. So my concept, my kind of proposition, my thesis, what I'm saying is the solution to what I think I'm right on this, and now we can argue about how, is you need crypto to be used every day. Fabulous. That means you need it to not be volatile. Okay, great, sounds great. How do you get it to not be volatile? Saying no volatility 3 times in the mirror doesn't get anywhere. I already explained what causes volatility. It's economic reflexivity indexes. Like you can even look at this in the equity markets. It's like stocks that are traded more are more volatile. That's why volume of trading on any given day for an equity will represent sharp dips, sharp ups. And like if you look at a candle, and I'm not a technical trader, but anyone that looks at a wick that goes like in a crazy direction, if the volume is at the highest, like 20 times higher than any other second, right? And so just every day you go to CoinMarketCap and you see it's over 50%, over 25%, it's not getting, it's obviously people are selling it too often for it to be stable. And so simple question, how do you make people keep crypto? That was a great question, right? I also think that the founders of fiat currency asked that same question maybe not on a Zoom call, but maybe sitting in some anachronistic palace somewhere as they define the new world. But it's a mind-boggling concept, and we will solve it. And I mean we. I don't mean our company or myself. We will solve it. I think that we are committed to cryptoizing the world. The question is, are we? How creative can we be? I mean, that's going to become the name of the game. How creative can we be? How much can we work together? And the time, and then there's companies that are well on their way to doing it. We're already doing it, but it's almost like this is a once in a, I mean, I was a generation. This is a once in a millennium opportunity to educate at the same time as conceive the foundation of money for the foreseeable future, right? And so that's what we want to do. I mean, not just we. I don't think that's just my objective. I think that's a lot of people's objective, and we want to proliferate that.
And I agree that there's a lot of creativity that is needed in this space. It is truly a very, very young space. I think as the same way that the internet has just grown to be like 20 some years old of adoption, this cryptocurrency, the new form of currency, is about 10 years old. And Debbie, I agree. I'm glad that we are having these meetings to actually gain insights about currency in general. With that, I want to leave you guys with a reward. on these daily live podcasts and Zooms of some gift. So if you would randomly, we're going to select someone based on getting a number as close to this random number generator of 1 through 100. So place your predictive values in the comment section, and then I'll hit randomize 1 through 100. Whoever is the closest will get. We'll find out whether it's $25. Actually, let me participate as well.
Yeah.
Um, yeah. Whoever's the closest will get 25, 50, or 75, or $100. But more than that, I hope that something in here sparked, as it has sparked in me, a deep curiosity to find out more. Because the more we understand and, as Sharpen said, feel the impact of what exactly interest rates are, I think we're going to make the proper decisions to participate in it, or to actually do well, to avoid some of the trappings of it. So with that, I'm going to hit randomize. 34 would
Oh,
put
man.
Debbie in a very good
Wait, Debbie
position.
did 50, right?
Yeah, yeah, yeah.
Yeah, that's
And
like that's a hell of a number. That's a hell of a number. Yeah,
that was,
assuming nobody like everybody usually guesses on the periphery. Like I guessed 8. I know there's another under 10. Someone guesses a 90, then she's phenomenal position to win.
oh, wow. So Debbie, if you would message me your GX email, I'll GX transfer you the funds, which, by the way, we'll find out exactly how much they are at a multiplicity of 4. So that is going to be $25 for this one, and we'll continue on every single day. So join us on the next one, which is actually going to be tomorrow, a different podcast on a different topic, which I'll post about in the group. With that, we will catch you guys same time, a different day. Take care.